It's the morning drive, and it's personal finance now here on the show. James Thomas is with me. James is an independent financial consultant. Now, last week at this time, it was a conversation about investing vehicles, asset classes, that kind of thing. This time, it's about how you do it, your style of investing, I suppose, really. So essentially that means, are you active or passive in the way you approach your personal finance? It's the great investment debate. James, nice to see you.
And you.
This is one of those topics that we could spend, I don't know, 7 or 8 days sat here talking about.
Probably, yes.
Yeah.
And I'm conscious that, as you rightly say, we could get into such minute detail as to really frighten people away from investing, and that's very much not what we want to do. And if we rewind back to our first few conversations and part of the fundamentals of financial planning, I want people to have knowledge of what they're doing and some understanding, we can quite easily tip into going into such detail as to perhaps, as I say, scare people off. So it's a fine line. But however, this is a very big part of the financial planning, is that passive versus active management. What is the difference? Why are there such differences, and what do they really mean?
You're right, and the thing is this: we all learn at different paces. We all have different interests. We have different ways of living our lives, and it kind of runs in accordance with that. Because there are kind of two types of people when it comes to investing. Really, you're either, okay, I'm in this for years. I've done this. I'm going to leave it. I don't really want to get too involved. Or you're really active and you want to stay on top of it, and you have this thirst for knowledge. And they're both really reasonable ways of investing.
Both very valid, absolutely. Yeah.
Okay, so let's start with a passive investor, somebody that is living their life and they don't really want to get too involved, but they want to be safe in the knowledge that they're doing something. How would you define a passive investor, first of all?
Well, a passive investment, rather than the person themselves, because I'm sure then very few people are completely passive about their investments. And indeed, even a passive investment still has an active element to it.
Okay.
By passive, we mean it simply follows an underlying index or asset class. Yeah. So the most popular one that's utilized is the S&P 500, the Standard & Poor's 500, the top 500 companies in the American stock market.
Yeah.
And perhaps another name that people would see mentioned is a tracker fund, because all a passive fund does is simply track that index.
So instead of buying a stock, you buy part of a fund.
Yes. So again, to rewind, absolutely. So we're going right into detail. What all you and I would see as the individual investor is a holding in the S&P 500.
Okay.
But within that, so again, if we go back to previous conversations, this is to allow us as individual investors, smaller investors, to gain exposure to the wider index.
So you get to join the club.
You get to join the club with a more modest amount of money.
Right. So, So the barrier to entry is far lower. You can start to build that, and perhaps over time you grow your knowledge and you become less of a passive investor, and you are more active in. Okay.
So the actual definition is simply following an index. So use the S&P 500 because that's the most followed index in the world. I'm pretty sure. It's certainly the largest.
Yeah.
So your asset or your investment, would simply follow exactly what's going on in that market.
Other stock markets may be invested into. We should
absolutely. I'm just using that as the example. So the UK, almost every country will have its own stock market. The UAE, obviously, indeed, you've got three: Abu Dhabi, DIFC, and indeed the AGDX down in Abu Dhabi. And all of those will have index funds that follow the underlying holdings. And indeed, again, that was something big. Step forward with the UAE a few years ago when it became part of the emerging market, or classified as an emerging market rather than a frontier market, because it meant more funds would then have a requirement to invest into the UAE. But
Sure.
again, getting very technical, but it's just part of how these funds are constructed. So again, rather than having to be active in selecting those investments, all of this is going on below the surface, if you like.
Okay, I'm with you. No, I really am with you. I mean, I did a lot of reading and thinking about this today because the issue with us talking about how active you are with your investing, how passive you are with your investing, it's kind of the next stage. You've decided to invest. It's the natural place to go to. However, there is so much to talk about, and the thing about this discussion is to try to structure it to stay on track, as it were. So, somebody who's investing actively is a person who buys stocks or other investments regularly, and they're looking for performance and staying on top of things. Is that a reasonable kind of definition of somebody who's active? Okay, so a passive investor, by the same token, is somebody who would maybe rarely buy individual investments. They would probably prefer to hold a fund for a longer period of time.
Yes, and again, just to perhaps clarify a bit further. So that would be the next stage on, in my opinion, when someone is actually taking the trouble to do their own research, to pick their own underlying stocks and funds, or not even funds, sorry, individual shares. So if we're talking the difference between passive and active funds, which again is already perhaps quite
there's crossover, isn't there?
There is a crossover, but it's a very close definition.
Yeah.
They're both funds. They're both investing into a market, but the key many differences. One of the key differences, picking on that S&P 500 again, the passive will simply follow exactly what the top 500 companies are, and the percentage that each company within those 500 companies occupy within. So use say S&P, the FANGs as they were called: Facebook, Apple, Amazon, Netflix, was that be Nvidia now, I'm guessing, but Google. They top 7 companies on the US market. I don't know the exact percentage, but will probably make up 50% of the market.
Of that 500.
Of that 500.
Yeah, okay.
So you'd have maybe the top 10 holdings making up 50%, and the other 490 making up the other 50%.
Okay.
So you can see, even though it looks very diversified, and again, I appreciate I'm getting very technical here, but it looks diversified, but you've actually, in reality, got 10 companies making up the vast majority, and the other majority making up the minority of your holding.
Well, here's an example for you to maybe clarify that a little bit more. Look at Spanish football. It's a 2-horse race between Real Madrid and Barcelona, really.
Yep. Or even more so in France with Paris Saint-Germain.
Well, exactly. It's kind of a 1-horse race, at the moment. And a great team they are, it has to be said. But that's an equivalent, isn't it?
But it does, absolutely. It makes the point. So you've got 2 companies, 2 teams that make up, 9 times out of 10 win all of the prizes in that country. And so it's the same analogy, or the similar with the fund. Using that passive management, it would always replicate what's in the index. Whereas the key difference is the active is, rather than being a black box, a computer that just says allocate as per the underlying holdings. The real person or persons, the team, the fund managers, would actually say, well, our view is we don't want to have money concentrated in those 10 or 7 or 10 companies. We actually believe within that other 490 there are many opportunities that we can take advantage of, and we would rather go overweight in those companies and underweight in the companies that are already vast and have achieved what we think the companies sitting in the other pool could potentially generate.
Okay, so how about this as a definition of active investing or investors versus passive investing or investors? Active, somebody who's buying stocks and investments regularly. Passive investor, perhaps more leaning towards working with fund managers to have it done on their behalf. Is that a good way to add?
Yeah.
to that definition? Okay. So
Yes.
that's where I wanted to get to, because really, you lean one way or the other. Most of us do, I guess.
Most of us do, but I think coming back to a previous
There's always a
conversation,
but with you, isn't there? I know. That's
again,
why
there's
you're
no
here.
right or wrong answer. But
True.
the way I say that but there is because I would always advocate a blend of the two.
Okay.
So if we're building a portfolio and a client comes to me, especially with a lump sum,
Yep.
we'll have some of it in passively managed, often used as the core and satellite, to have your core holding, perhaps as something that the more safe, the passively managed, and then on the satellites so that sit around it can be where we look for that extra performance, the additional returns can be generated, because potentially, if we're looking at that pool of smaller companies, it may well be that they are startups. To get on the S&P 500, they won't be startups, but they will be smaller. They may well be newer companies. So they may have more opportunity of one to go up, but also to go down.
Okay.
So by combining the two, my view would be you'd get the best of both worlds. You'd have your core holdings that follow what the market does, relatively stable, relatively secure, and then have opportunities that surround that to give you that extra overperformance, but not to the degree that all of your money is at risk.
We're going to come to diversification in a little while, but that's exactly what you're going towards. I'm with you now. When it comes to deciding how you're going to invest, the style that you're going to employ, whether you're working with fund managers or you want to take on, learning and growing your knowledge, or you have a really good idea of where you want to be, whoever you are, however you are, is there a type of person? Is there a type of person that leans to any particular style? Could you pick somebody out of a crowd and say, "Oh, there's an active investor"? Is that even a thing?
Probably, but I would suggest it's quite a difficult.
I would think it would be. But are
typically,
there typical characteristics?
I'm going to suggest that someone who's quite technically minded, so therefore knows where to look. They've got maybe get their Bloomberg terminal, get the to be far more analytical.
Yeah.
So again,
by
perhaps
nature, you mean?
by nature.
Yeah. Okay.
So the accountant, the that engineer, someone who's regularly looking at data, looking at information.
Right.
So if that's their part of their day job, typically, and again, it's not always the case, but they're the sort of people who would then be able to analyse that the accounts of the business, look at what their projections are, what is the CEO saying or the CFO saying about the business, be able to interpret that and decide whether they want to follow that as their investment profile.
So I asked that for a reason, because Muzamil, who works here, he's kind of our I suppose our tech guru, really, puts all of this stuff together and makes it work and talk to each other, software-wise. He's an investor, very much an active investor, and he'll talk about things. And I'll be completely honest with you, it's just of no interest to me. It's not my thing. Muzamil's a nice guy, but when he's talking about that, it's just not for me. And what I'm trying to get to is there a type? And if there is, if you are of an analytical slant in your nature, you may be more suited to it. But that's not to say you can't, learn to be, to grow your money at all. But the point is, if you have an active interest, it's like I always think if you're interested in something, you do it better. Is my point.
Yes.
That's where.
Again, that's why I would suggest you come to someone like myself. Because one, you may not have the expertise.
Beautifully segued too, by the way. Yeah, nicely done.
Because you may not have the knowledge, but not want to have the knowledge. Your brain is already full up with everything that you already enjoy and want to occupies your time. Therefore, you hand it over to other professionals to look after it on your behalf.
Yeah. Okay.
But that's not to say as the process goes, and typically it does happen when we start this process with someone who would claim to say they know nothing. Once they're a year or two in and they've seen their statements and they start to then ask, well, what does this mean? What is this fund? Where is it invested? Where can I get more information? Because they can see the returns, they can see what's going on, they can hopefully see their money growing. And it starts, well, actually, this is really quite interesting. This is really helping my future planning. What's going on?
You see, this is the thing,
and it's
isn't
not
it?
just then an abstract thing going on somewhere else. This is real. This is my money is growing. Things are happening, and therefore I want to participate.
Well, depending on how things develop, I mean, it could turn out that you're better at this, or not as well, to be fair, than you thought. You know, things change over time. So you could start off with a very passive approach. Look, you know, just handle this for me. I want to be able to send my kids to college, whatever it is that you're saving for or investing for. You could then grow in confidence, as you say. You see things starting to grow, and all of a sudden, James, you've got a Warren Buffett on your hands there. You know, who, you know, from a passive investor to somebody who's very active.
Yeah, potentially.
Yeah. Okay. Let's move to objectives. If you take a passive approach, is there a general view on the objectives of somebody who, you know, takes, you know, the back seat, as it were?
I think the objectives are what we would have identified in that fact-find process. So no, I don't think there's potentially a difference. They're looking for the same outcome. That is to build assets for their future, for their children's school fees, whatever it may be. So the objectives are largely the same. It's just how you go about achieving those objectives. Do you want to just hand it over to a professional to manage it on your behalf? Or do you want to be far more involved in that process, or somewhere between the two?
Okay, so if you let's look at why you should let's look at how you move forward. The next step, you've identified how you want, whether you want to be a little bit back seat, or perhaps you want to be a little bit front seat, driving, as it were. I know you're a car guy. Next step, I'll leave it with you. The floor is yours.
Well, I'd say the next steps, like we're talking about that previous example, often the case someone comes to you, wants advice on where to invest, either on a regular basis or they've already accumulated a lump sum, and they find themselves, as I say, being more and more interested in what's going on. So they start in the back seat, to use that analogy, and it's managed, it's running well, they've got their portfolio, but then often you'll get fun fact sheets, you'll get updated information from ourselves, and so people then start to read, they then start to research, and a good example, one that I've had to then perhaps calm people down about, was cryptocurrencies.
Okay.
Next best thing, must invest into this. Potentially yes.
Right.
But would I be recommending taking 100% of someone's portfolio and putting it all into cryptocurrency? Absolutely not. Would I recommend any asset class?
The alarm bells.
The alarm bells are ringing.
Right.
And that's sometimes where you have to rein people back a fraction, because they do get very enthused by what they've read, what they've researched. And just to say, this is, yes, absolutely, we can take advantage of that, but not for the whole portfolio.
Well, isn't it the case very often, and this extends to life, not just, you know, the financial side of your life, that if people are, you've got to get on this train, otherwise you're going to miss the boat. Excuse the mixing up of analogies there. But if you are being told to get on the train because you'll miss the boat, then you've probably already missed the boat and the train's out of the station.
Yes.
Is that
often the case? What's the other analogy? If the taxi driver's telling you to invest, then it's time to sell out. You know, it's the opportunity has already passed. And going back to my previous example of the S&P 500, I think that's perhaps more pertinent. It's finding companies that are in that 500. Perhaps that's probably a more relevant and useful research. And we've often seen people want to invest into startups, new businesses, because that's, if you can find the next NVIDIA, to use that as the most, the largest returns we've seen in the last 20 years. If you can find the next one of those, but the trouble is, there'll probably be 1,000 other companies that have potentially claim to have the next technology that will disappear and never be seen again.
And this is where you have to do the work. You have to put the time in. You have to do the research. This is why
Yes.
you use a fund manager. And if you decide not to, you need to do the work.
Yes.
Okay.
And that's the where we're reaching a conclusion already. But that is absolutely the case, because there's so many people that have come to me and said, I want to do X, Y, or Z. And it ends in tears, because it's doesn't turn out to be quite what they thought or hoped it would be.
Okay. So rein in those expectations.
Just rein in those expectations. Yes, it's very easy to get carried away and see some amazing returns, but it's 1 year, flash in the pan. What's happening next year, 5 years, 10 years? This money's for 20 years, 40 years in the future. Is that opportunity still going to be as valid in that period of time?
Well, that's interesting, because that's the way you have to think. If you're at this next stage and you want to do more with your money, you've got to be looking at the next NVIDIA, to take your example there, and thinking, hold on a minute, this is a company who are projecting forward 2, 3, 5, 10, 15 years. And really, you have to take that same approach, don't you?
You do. Because you are. If you're building for your future, your pension, your retirement, and you're 40, 45, well, that's 15 to 20 years in the future. But then, crucially, that's when you retire. It's not, the money doesn't just stop then. You want it to then last for your retirement, which is hopefully another 20, 25, 30 years. So it's actually a very long window of investment that we're talking about.
Well, this is another thing, isn't it? That we're more and more we're thinking now that, hold on a minute, we are living longer. 150 years ago, we lived to 30, 40, if we were lucky. Now we're living to 80. Science and health care is changing. It's moving towards longevity. So we are going to be living longer, and that produces some real world issues, i.e., how do you fund it?
Yes. And again, perhaps getting slightly off topic, but it is still related to this. It does. Your money is going to have to last you an awful lot longer than your grandparents or your great-grandparents. So making the right decisions now is absolutely crucial. So picking that investment that generates the long-term stable return, which is where being more passive, certainly for a large proportion of your money, I would suggest is more sensible. It may not get those shoot the lights out massive returns, but year in, year out, it will generate good returns for you. I often would say to people, if they start to get more interested, want to do things, take a small amount, and set up a little account, or even just ghost trade, not actually invest.
Right.
Just set up a little spreadsheet. Pick the companies that you would invest to, note down the price they are.
It's a great way to learn.
And then for 6 months, just track how you would actually get on.
Okay. I'm going to ask you next, passive investing, is that better than active investing? That's next on Mira Business FM.
Mira Business FM. Mira Business FM.
It's the morning drive. My name's Tim Elliott. You are with us, perhaps at mirabusiness.fm, the website. Could be with us on YouTube, on Twitch. You'll find us on Instagram, on Facebook, on LinkedIn, X for news. And we'd love to hear from you. Get in touch. WhatsApp.mira.fm is the easiest way to WhatsApp without having to remember numbers, or you can email info@mira.fm. Wherever you are, subscribe and let us know how you feel. That's always appreciated. Now, on the morning drive, at the moment, it's about investing. Active versus passive investing really is what we're talking about this morning. James Thomas is an independent financial consultant. I have essentially tied him to the seat, so he can't go anywhere, but he is still here. And the question for you now, James, is we've kind of, I think, relatively well defined a passive approach to investing money and an active approach to investing money.
Yep.
That's relatively understandable, I think. But I do have to ask you, of those two, which is best? You're laughing.
I am laughing.
Which one makes more money? There's no answer to that.
There's
for
no
obvious
answer
reasons.
to that. And each camp will have very potentially strong opinions on which one works best. The passive approach typically has lower fees, so there's less cost being taken out. So any returns you get, you receive more of them because it's a black box, a computer typically that's running the underlying fund. Because as we mentioned, it's simply just tracking whatever index that you've selected. Whereas with the active, you have a fund manager or a team of fund managers, so there'll be an annual management fee, 1 to 2%, maybe a performance fee, depending upon the type of fund. But it may well generate more returns because of the examples that I've mentioned. It can go overweight in particular areas. It can go underweight in other areas. It can be far more, as the name suggests, actively managed. It's not going to simply track whatever the index does. So the index goes up, it's great, but when the index goes down, it's not so good. Whereas with the active approach, they can be mitigated by being able to buy and sell the underlying holdings far more regularly than you would do with a passive fund.
But there are varying levels of active approaches, aren't there, obviously? And it's not to say that you can't do better than a fund manager. I mean, you would think a professional money manager's capabilities would trump a basic index fund. Very often they don't.
They don't.
No, that's reasonable. Let me give you some historical perspective on this, just to see what you think. And again, this is a discussion. This is not to say that any one position is better than another. But if we look at superficial performances, results, passive investing works best probably for most investors. And here's why I'm saying this. Decades of studies, many studies show results for active managers that perhaps a little disappointing. Active mutual fund managers overall consistently underperform their benchmark index. For instance, research from S&P Global found that between, I think it was 2002 to 2022, that 20-year period, it was just over 4%, 4.1% of professionally managed portfolios in the United States, this is a US example, consistently outperformed their benchmark. So that means nearly 95%, just over that, didn't. So becoming an informed investor, this is the point I'm making, doing it yourself offers hope if you do your homework. But that really is simply the case, which points towards the phrase that we've used, I think, over the last three weeks, probably more than any other, time in the market rather than timing the market.
Yes. I mean, again, if there's an overarching advice that I would give, it's not actually to be so making so many changes to one's portfolio, because I suspect the funds that have underperformed the most, again, this is purely from a gut response. The more active you are you trying to predict when the market is going up or more importantly, when it's going down, will lead to underperformance. Because I think similar results from Standard & Poor's or numbers, analysis will show that even if you miss as few as 10 days, 1 day a year in any 10-year period, it can halve the return. Because when markets fall, the next usually is followed by a very swift recovery.
Yeah, very often. Yeah.
So if you miss that, you're feeling smug, you've got out and not had the fall, but you then miss the upside and probably more upside because you're still thinking, are we out of the particular issue that's caused the fall?
Well, this comes back to a point that we've made as well, doesn't it? That markets are full of people, and people work with their emotions. And if you're
a lot of emotion, but there's also now more and more computers, boxes, and they're just trading.
Those black boxes that you love so much. He's so measured about this. You want to say something, but you're trying to phrase this in the correct way, are you not?
Absolutely.
Okay.
We're not going down there. It's just about making sure, missing that opportunity, but also not panicking.
Yeah.
So it's both. It's if you can just take, again, as we've said before, take that emotion out of your investing. which is we're handing over to an active manager or being passively managed, i.e. leaving it to someone else, the chances are those emotions are taken away because they will do that for you rather than trying to pick and choose, predict where the market is going to move to, and sometimes getting it right, but also getting it wrong.
You can't get it right all the time.
You can't get it right all the
You're going to
time.
make mistakes, but if you have the ability to keep calm, keep control of your emotions, and think things through, that's the first step, isn't it?
It is.
Better.
Very much so.
That's what you're saying.
And just as I say, ride out those peaks and troughs.
Right.
Because what looks to be, it's the old analogy, what's news today is tomorrow's chip paper wrapper, but also what looks to be the biggest issue and all the markets are going to crash, invariably there's a solution is found. If we look, the mega crisis, shall we say, the dot-com bubble bursting in 1999, the global financial crisis 08, 09, the markets reached their low in March 09. By September of the same year, they had recovered 50%.
Yeah. Historically, markets tend to rise.
So markets, exactly. So if we go back even further, I can just about remember Black Monday in the UK. Markets fell 20% in one day. Within 18 months, they'd recovered.
Right.
But if you had seen that fall on that Monday, sold, and then not reinvested until 2 years later, you would have missed 20 or 30, well, actually because you've fallen, so it's a 40% return. And that's quite possible because if your mindset was, well, why would it recover? I need to stay out, wait until the conditions have improved, rather than just saying, I'm in, I don't need this money for 20, 30, 40 years. Actually, and indeed, if you now look back at the charts of those what were huge movements in market, time squeezes the impact of them. And if you look, the line becomes more and more smooth on an upward trajectory.
Yeah, lines tend to go uphill, don't they, over time? Okay,
yes.
Right.
So that's really where I'm trying to say. In summary, is do not panic, leave the money invested, take the be more objective.
And if you take an approach that you diversify where your money is, different sectors, different geographies, etc., different asset classes, I guess, that mitigates that worry.
Further mitigation of worry, absolutely.
Okay. All right then. So, natural next question, really, and this is a huge topic in and of itself. I'm kind of loath to ask it, but we do need to talk about this: how you build a portfolio, and also. By natural extension, how do you maintain a portfolio?
Both crucial. Building in the first place, if you're looking more at the passive, utilising fund managers, then it will be to start with equities and then the big markets of the world, so US, UK, Europe, Asia, and then a smaller proportion to emerging markets. An element of bonds, so the debt we've discussed, because while the returns may not be quite so impressive, they give a good counterbalance for when equities are underperforming, property, and then commodities. So gold, oil, again, there can be funds that invest into all of those. So it gives you a wide spread. And by utilising funds, again, comes back to our point that you can then get your money across many, many more sectors and areas of investment that you can just simply could not do as a smaller personal investor.
And another point to make here is you could do this yourself if you want to. It's totally down to you. The information is there. If you type in active investing into a search engine, there is no shortage of advice there. Whether it's good advice or not is a different thing. But it is about research. Or you can take an active approach with a fund manager or a passive approach with a fund manager.
Absolutely. Or a combination of the two.
Or, as you're going to say at the end of this, I like a blend. We'll come to that in a minute.
But then your second point about reviewing. So we build a portfolio today that we think is optimal for your requirements, your attitude to risk
At that point in time.
at that point in time.
Yep.
But even so again, we always say then the most crucial part, arguably, is then to review that on a regular basis, because different sectors will move in different rates of return. Some areas will fall out of fashion, or fall out of, but their performance will fall. So therefore, do we want to stay invested in those? Maybe we feel that it's a temporary fall and therefore to stay there, or do we redirect those investments elsewhere? But that's the conversations that we would have on that regular basis to make sure the portfolio maintains that optimal, and indeed to rebalance between those sectors to make sure that the spread stays as we want it to be.
Okay, and again, this is about taking the emotion out, isn't it? Because, some people look at a particular investment and think, I really believe in that. It's not doing great, but I still really believe in it. But you have to be able to take a step back, perhaps take the advice of a broker, a fund manager, whoever it is you're working with, a consultant like yourself, and take a step almost outside of yourself and just think, right, okay, well, where is this really going? Maybe this is something I should leave for now. And often those decisions are quite hard.
They are.
Because you've taken that decision based on how you feel or what you believe in.
The most natural way is that emotional response.
Yeah.
So to be able to take that away and actually act on a very objective level, it can be very difficult.
Yeah.
Especially if you believed in whatever it may have been and it hasn't delivered what you'd hoped it to, or conversely, it has produced some huge returns, and the argument then is to realise those and redirect part or all of that investment elsewhere.
All right, then, let's talk a little bit about risk here, because I think risk versus reward, risk versus return is a really important to think about. It's a hard thing, it's a hard concept to get your head around, because I think very often you'd say to somebody, so what would you be willing to do? Oh, I'll give everything a go, and I'm in 100% for this. But when it comes to it, obviously
really, exactly. It can be a lot of bravado, very bullish until you really are at the point that
until you need to sign the check.
Signed the check,
as it were. And naturally, I mean, that's a good way to be, to check yourself, if you like, as well. But, the risks of active investing, I guess, are potentially the gains are higher, but there's also the underperformance aspect as well that you have to consider. So in every way, this is a balancing act.
Always. You're on that seesaw. You've got to balance the level of risk versus the level of return. And are you comfortable? I mean, again, this is your attitude or your acceptance of loss.
Yeah, okay. Well, that's a nice way to put it, because that's the honest way to put it.
Yes.
Yeah. Risk versus reward. No, would you be okay with losing X amount of money or not?
We start to really drill into it. If I was to say to you in a year's time, Tim, right, you've invested X, it's now worth 80% of what you invested. How would you feel?
I wouldn't be buying you a cup of coffee that day, let's put it that way.
So therefore, that really helps. That's a very practical way to see where people's real level of risk appetite is.
Yeah.
Because that is the reality of, if you're being very bullish, wanting to be very active, take a more front foot approach and to say, we're all in on whatever it may be. But okay, it's been the returns, again, past performance is not a key to future performance. And again, it's quoted all the time because it is so valid. I do not have a crystal ball. None of us do, as far as I'm aware. So therefore, you need to really be comfortable with what's going to happen, or could happen, sorry.
Yeah.
And if it is, no, I don't want to be sitting here in a year's time down 20%. Well, okay, then let's dial back on the level of risk that we're taking to ensure that does not happen.
Right. Okay.
And yes, that might then mean the upside is also lower. And often I find, and have found over the last 25 years, that the push, when people are I don't like to push, but when the discussion is actually to the point, it's the losses are much harder to deal with than the returns. And hence, I would always err on the side of caution, because I'd much rather see a slightly lower level of return to protect against that bigger downside.
Sure. Okay. I guess for some people, for the, people who are willing to take a little bit of risk, the losses kind of mitigate the wins, don't they? So a bit of a loss here, but the wins are that much sweeter if you're that kind of person.
And again, if you are, that's fine.
Well, that's what this is all about, isn't it?
It is.
The point of the risk appetite conversation, risk versus reward versus return, well, however you want to phrase it, is it's a decision that you have to make, that you always use the word comfortable with this, which I think is really interesting, because it really is about whether you have comfort in the position that you find yourself in. Because it's where you find yourself, it's where you've put yourself. That's the key.
It is, absolutely. That is the key. Where you have put yourself.
Yeah.
And you need to be comfortable with that.
I got it right.
You did. And
it's true.
And that is the fundamental of what we're talking about. Right. Everything else, dare I say, it's not peripheral, but what it leads to is that internal discussion. When you're on your own and you're thinking about it, can I live with myself if this were to happen? Yeah. And again, it's very deep, but it is, because your hard-earned money, you've invested it. What do you want to happen? People can be very flippant. Oh, I want to grow 50%. Okay, but can you cope with a 50% downside? Because to get that level of return, there will be a downside risk.
And what's interesting about this conversation is we always seem, and there's a reason for this, because this is the crux of it, we always seem to come full circle, because it comes down to you and how you feel and where you want to be. And that's the thing. And that's why I think some people take care of their money themselves. They're happy to do that. They're willing to take on the risk. But so many people talk to financial advisors and I think kind of miss the point of connecting with the consultant in some ways, because it becomes a very personal relationship, because these are difficult things to talk about. Money's a hard thing to discuss. So the trust issue is not just somebody trusting a person like you to help them, but it's also trusting themselves, isn't it? I don't want to get too deep about this, but that's at the core of it.
It is. They've got to be comfortable with the decisions that they have made and the process that they have gone through. Because if they're not, one, they probably won't do anything, or they may make the wrong decisions, and that then affects their future self, which is even more of an issue, because if people put off those decisions, again, it's the analogy when's the best time to plant a tree we've discussed before. It's the sooner you start, the better. But if you're not comfortable, most people will put it off and not start.
How many people have you spoken to over the course of your career, your 57 years in independent financial consulting, however long it is, how many times have you heard I wish I'd done that a few years ago?
So many. And I've actually, if I may, I've just put some numbers down. I mean, the rule of it's the 7.2% per year growth, and again, it's very precise. Okay. But if you are able to achieve that, your money will double every 10 years.
Good position to be in.
So it is a great position to be in. But it just shows you, if you had 10 years, obviously turn 100,000 whatevers into 200. But if you had 20 years, that becomes 400. Okay. So you can see the exponential growth, because it's growth on growth on growth.
And 20 years comes pretty quickly. I'm a bit older than you, and 20 years ago was 2005.
Yeah.
40 years ago, 1985. It's not really that long ago. I mean, these are realistic time spans if you consider it as part of your life, which sounds like an odd statement, but
and again, it will be that. Financial planning is sometimes viewed as abstract or out there, or it's something that someone's trying to sell me something. And sadly, that often is the case. But what we're talking about is really the heart, or the core of what we're trying to achieve with people, is to get them to realize that they need to know what they're doing, what their goals are, what opportunities are available to them, what their personal level of risk is, and then to actually do something, and then to regularly review that, because circumstances will change, as we've discussed in previous discussions.
Just a line on diversification, because I think that's something that's come up a couple of times today. It comes up very regularly, but it's really important to understand that you need a spread, don't you?
That's all diversification is. In simple terms, it's a spread.
Yeah.
Now, different people will have different views of that. So as we've just discussed in building that portfolio, we were talking about diversification in the sense of asset classes. But then if you're an expert in one particular class, if you're into property, commercial, residential. But then even with that, apartments, houses, townhouses, etc., commercial, offices, various types of assets that can be within that one area, or even though it's just titled property. And then if we go into equities, again, we're using the S&P 500, again, within that, there's 500 companies. So there is a level of diversification.
Yeah.
But why just be in the US when you can also be in the UK, into Europe, into Asia, the emerging markets? There's many, many opportunities. And that's what we're trying to achieve, is to get your money spread across all of those areas.
Right. Simple as that, isn't it,
Yes.
really? Let's just conclude this. We've got about a minute left.
Okay.
Strategies, I mean, is it right to be passive? Is it right to be active? My guess is you're going to say, look, it's
There's
a combination,
no right
really.
answer. It's a combination, always.
There are no silly questions, are there? There's no right answer.
If you're very strongly minded to one or the other, great. But again, it's that being comfortable again. You need to be sure that is exactly the strategy that you want to pursue. And if it changes, that's fine. Typically, as people age, they will want to take less risk because they're becoming closer to the ultimate goal of what they're saving for.
Sure.
But that can still accommodate both strategies.
So there's no one-size-fits-all answer. Your ideal investment approach depends on time horizon. So longer-term goals generally favour passive investing. It's good to be in the market for a period of time. That's a reasonable thing to say. Be comfortable with risk. Your involvement level is really, that's where you decide how active or passive you are in your approach. That's very much a personal decision. And I guess you need to be wary, or at least consider fees in terms of how you approach it.
All of the above. Fees are always a key component, but don't be afraid to pay for someone's advice if you think it's of value to you. And likewise, don't pay it if you're not getting the value that you think you should be.
There's
as you would with any other service.
Well, absolutely right. There was a quote that popped up online when I was thinking about this yesterday, making some notes that we could use to talk to you. And here it is. Passive investing mirrors a market's value, whereas active investing means choosing individual securities to buy and sell. So taking control. Really. Absolutely. I just thought that was quite a nice thing to end with. Look, James, I always like talking to you. It makes a lot of sense. The great investment debate today, active versus passive investing, where you might want to go, things you might want to consider. James Thomas is an independent financial consultant. Good to talk to you.
And you. Thank you.
Thank you. This is Mira Business FM.
Mira Business FM.